Hello and welcome back to Invest with King. Warren Buffett is renowned for not only surviving market crashes, but also profiting from them. His approach is simple yet highly effective. He prepares for downturns and seizes opportunities when others panic. Buffett has always maintained that the best thing that can happen to Berkshire Hathaway is for markets to drop, as it presents him with the chance to buy quality business at low price. This strategy has played out multiple times, including during the dot-com bubble, the 2008 financial crisis, and even in today's uncertain market. Before the 2000s collapse, Buffett's moves were particularly telling. The late 1990s saw the stock market in a bubble, with tech companies reaching absurd valuations despite many of them being unprofitable. One glaring example was an online toy company that had a price-to-earning ratio in the thousands, something that made no financial sense. Many investors got stuck up in the frenzy, believing the internet would revolutionize business and justify the extreme stock. However, Buffett remained cautious, as he always does when markets appear overvalued. Fortunately, Buffett's investment strategy is no mystery, and all of his past reports are publicly available on Berkshire Hathaway's website. By examining the balance sheets from that period, we can see exactly where he placed his money, how much cash he held, and what he chose to invest in leading up to the crash. Buffett has long studied financial history, dating back hundreds of years to events like the South Sea Bubble, the Tulip Mania, and various panics in the U.S., including the time the stock exchange was closed for months in 1914. His guiding principle has always been that anything can happen, and investors should structure their portfolios so that even in extreme circumstances, they can survive and continue investing. In 1998, while the stock market bubble was inflating, Buffett had allocated $36.8 billion to the wholly owned businesses, much of which made up 40.1% of his portfolio. These were companies he had acquired over time, like Nebraska Furniture Mart, the insurance giant Geico, and See's Candies. Unlike stocks that trade on the public market, these were private businesses under Berkshire Hathaway's direct control. Buffett is known for holding these businesses for life, viewing them as stable long-term investments that generate steady cash. In addition to owning businesses, Buffett had $13.5 million in cash and cash equivalents, which accounted for 15% of his portfolio. This cash was primarily stored in short-term treasury bills, a move consistent with his strategy of keeping liquidity available when good investment opportunities arise. Buffett has always maintained that while he doesn't like large amounts of cash for the sake of holding cash, there are times when the best move is to stay liquid because attractive deals aren't available. He would rather have all of his capital working in productive business, but sometimes waiting is the best strategy. At the time, his largest allocation was in equities, with $39.7 billion in publicly traded stocks, making up 44% of his portfolio. Although Buffett's stock holdings change over time, a look at his investment position from 6 years earlier offers some insight. At the top of the list was Coca-Cola, valued at $3.9 billion, followed by Geico at $2.2 billion and ABC at $1.5 billion. Other holdings included the Washington Post, General Dynamics, Freddie Mac, and Guinness. These were strong, fundamentally sound companies, vastly different from the speculative tech stocks that dominated the market at the time. Buffett has always emphasized that while stocks are safe from the long run, they can be highly volatile in the short term. In fact, Berkshire Hathaway itself has experienced 3 separate 50% declines in stock price since Buffett took over. However, he's never worried about these temporary setbacks, as he understood that over time, American businesses continued to grow in value. His mindset was simple. When investing in stocks, you are buying pieces of real businesses, and if those businesses are worth more in the future, you will invest. Leading into the dot-com crash, Buffett was actually quite aggressive in his investment approach. He wasn't hoarding cash as much as some might have expected. Instead, he was making big acquisitions. In December 1998, he made Berkshire's largest acquisition at that time, purchasing General Re for $22 billion. That same year, he bought NetJets, a struggling company with significant debt, at a significant bargain price. In 1999, he acquired Mid-American Energy for $2 billion. These moves show that while he was cautious about the overvalued stock market, he was still eager to deploy capital into quality business when the price was right. Fast forward to 2007 and 8 financial crisis, Buffett once again demonstrated his ability to navigate downturns. The American economy, which he compared to an unstoppable train picking up passengers and cargo along the way, was about to be derailed in one of the worst crashes since the Great Depression. Even before the crisis hit, Buffett had expressed frustration in a 2006 interview, noting that he couldn't find any attractive deals. However, when the market collapsed, opportunities emerged and he was ready to act. Leading up to the financial crisis, Buffett's portfolio was worth approximately $167 billion. He held $37 billion in cash, accounting for 22% of his portfolio. His wholly owned businesses had grown to $55 billion, making up 32%, and his stock holdings were valued at $75 billion, or 44% of his portfolio. At that time, his largest stock holding was Coca-Cola at $12 billion, which he had originally purchased for just $1.2 billion, achieving a tenfold return. Other major holdings included Wells Fargo, American Express, and Procter & Gamble. During the crash, Buffett employed what he could be called the Buffett bucket technique. His philosophy was simple: when it's raining gold, don't hold out a thimble, hold out a bucket. He used his massive cash reserves to make strategic investments in distressed companies. In late 2008, he bought $5 billion of preferred stock in Goldman Sachs, which provided him with stable dividends at minimal return risk. He also invested $3 billion in General Electric, securing a 10% annual dividend. Additionally, he increased his stake in Wells Fargo, which he already considered an excellent bank. Buffett also made moves in other industries, investing in IBM, Mars, Kraft Heinz, and completing the acquisition of Burlington Northern Santa Fe for $44 billion. While others were panicking and selling at a loss, Buffett was accumulating valuable assets. His belief was that as long as people continued buying groceries, paying for services, and engaging in business, these companies would recover and thrive. As the years pass and the new economic challenges emerged, Buffett's strategy has remained largely the same, though his current positioning is somewhat different. Today, he has been selling off large portions of his Apple and Bank of America stocks while making only minimal purchases. The stocks he has been buying are relatively insignificant, likely the work of his portfolio managers rather than Buffett himself. In a recent interview, he mentioned that he's not on an investment hunger strike, but that the available opportunities simply aren't attractive at current valuation. The only scenario in which Buffett would shift strategy is if stock prices fell significantly, creating bargain opportunities, or if a major company approached him with a compelling acquisition offer. Right now, his portfolio is structured differently than in the past. His wholly owned businesses account for 24% of his assets, valued at $188 billion. His stock holdings make up 35% of his portfolio at $271 billion, with Apple still being his largest position at 26%, followed by American Express at 15% and Bank of America at 13%. However, his largest position today is one that might surprise many: cash. He currently holds $42 billion in cash, which represent 41% of his portfolio. If he doesn't make any significant moves soon, this cash pile could grow to nearly half of Berkshire Hathaway's assets. Buffett has always claimed that he disliked holding excessive cash, but under the current market conditions, he finds it the most attractive option compared to the overvalued equities. Instead of following the trend of investing in high-flying stocks like Nvidia, Amazon, or Tesla, Buffett remains patient. His strategy is different from that of the average investor, and history has shown that his approach tends to pay off in the long run. Whatever the next market downturn arrives, Buffett will likely do what he has always done: accumulate, accumulate, accumulate.